Let me tell you something. There is no nobility in poverty. I have been a rich man and I have been a poor man, and I choose rich every fucking time. Because at least as a rich man, when I have to face my problems, I show up in the back of a limo wearing a $2,000 suit and a $40,000 gold fucking watch. Now, if anyone here thinks I'm superficial or materialistic, go get a job at fucking McDonald's, because that's where you fucking belong. So you listen to me and you listen well. Are you behind on your credit card bills? Good, pick up the phone and start dialing. Is your landlord ready to evict you? Good, pick up the phone and start dialing. Does your girlfriend think you're a fucking worthless loser? Good, pick up the phone and start dialing. I want you to deal with your problems by becoming rich. All you have to do today is pick up that phone and speak the words that I have taught you. And I will make you richer than the most powerful CEO in the United States of fucking America.
Welcome back to the channel, traders. So today we'll be speaking about the 7 ICT institutional reference points. So the first one, we have the order block, fair value gap, mitigation block, breakup block, liquidity void, hold high or low, and the rejection block. So guys, the order block, this is where the price level where institutions attempt to buy or sell without having a peer price. When it comes to order block, only institutions are taking orders there. So when it comes to bullish direction, the order block is the last sell candle, but the bullish candle must be aggressive. So we can have more than one candles that suppresses the red candle. Guys, you must mark out everything including the wick. When the body of the candle closes above the order block, then the order block is invalid. And the candle must respect the order block with wicks. So let me show you an example of an order block when it comes to the chart. Here guys, this is an order block. So basically, price broke structure, and then we mark out the order block, which is the last sell candle when it comes to a bullish direction. And as you can see, price broke structure here, break of structure here, and then price came back to the order block, and then price went back up. Here's another one. So price broke structure here, and then price went back to the last buy candle, which is this one, and then price reacted on the order block, and then it went down. So number 2, fair value gap. So fair value gap, it is an imbalance in price action. It is a gap between the candles. The gap is between 3 candles, and it must have a sequence of 3 candles. So how do we mark out a fair value gap? So basically, this is 1, 2, and 3. These are 3 candlesticks that are in a sequence. So we mark out from there until here. This is the gap. So price must come back to fill in this gap. So another one, for example, we have 1, 2, 3. These are the 3 candlesticks that are in a sequence. So how do we find a fair value gap? So it's in between here, the 3 candlesticks, and like here. So as you can see, price came back to fill in this gap by coming into this level, and it's basically filling in the imbalance. So there's a lot of example of a fair value gap. Here's another one. Okay, this one is 2 candlesticks. Here's another one. So basically, one candlestick number 1, candlestick number 2, and candlestick number 3. So the fair value gap is in between here because there is an imbalance, so price must come back to fill in this imbalance. So basically, as soon as price broke structure here, price came back to fill in here. And also here we also have the order block, which is this one. This is an order block here, and then this one is the fair value gap. So this is our point of interest. So price must come back to this level on the order block or the fair value gap. So when you have these two in the same place, we have a PD array. So this is the point of interest where price is most likely to come back. All right. And then we have the mitigation block. So the mitigation block is when we have a bullish mitigation block or a bearish mitigation block. So it is a failed order block that has now acts as a mitigation block. So the candle for bullish mitigation block must be blue, and the candle for a bearish mitigation block, it must be red. So mitigation block, it's so this is a bearish mitigation block, and then price is supposed to come here to this order block here, but like price doesn't, stops here, and then price goes down, So basically, price gave us this pattern here. So here we have breakout structure. We have a breakout structure. So now what price will do, price will come, it's supposed to come to an order block or a fair value gap, and then it's not. So price is gonna come to here. Most people call this place a neckline, and then it continues going down. So our mitigation block is here. So a bearish mitigation block, it's like this. And then price break structure, and then comes to this level, and then so here we have a breakout structure, breakout structure, and then price comes to this level, and then this is where we're going to find our mitigation block, and then price reacts to it, and then it goes up. So let's see for a mitigation block. Let's check out these things. So price did this, came here, this. So basically here we had a breakout structure, and then price what it did from here on. Then we mark out our mitigation block, which it is this one. This is our mitigation block, mitigation MP, mitigation block. So what price did from here, it went straight up into the mitigation block, and then it reacted, and then it went down again. Let's see another one. Okay, here's another one. So guys, we do find the 7 institutional reference points, a lot of them. So price started from there, it came here, and then came us here, and then went up here, and then here, and then up. So at this point, this one, this is our mitigation block. And B. So price came here and then it broke structure. This is where price broke structure, break of structure, price broke structure, and then it came back to a mitigation block. So for we have our breaker block. So our breaker block is when we have a bullish breaker block or a bearish breaker block. So it is a failed order block also. So the candle must push above the previous high or low with the full body or the wick. And the bearish breaker block is a red candle and a bullish is a blue candle. So a breaker block is basically the opposite of a mitigation block. So in this case, this high is lower, this high is higher. And then this is where we find our breaker block here. And then also when it comes to this one, it's the opposite. This one is higher. And then this is where we find our breaker block. And then we have our liquidity void. So a liquidity void, this is when there is an impulse, there is an imbalance in price delivery. It is a void in price due to momentum candlesticks, a sell side candlestick imbalance, and a buy side is insufficiency. So price will come back to fill in the void. So basically liquidity void is the imbalance in the market. Like when we have this is a liquidity void, this one. There is a buy side insufficiency here. So price is going to come back in the future, which it did like here, to come in and fill in this imbalance here. So price always comes to fill in the imbalance all the time. Like here we also have an imbalance. This is an imbalance. So price in the future always comes back to fill in the imbalance like it did here all the time. Also we have an imbalance here, and then price gonna come to fill it in the future. Okay, cool. So number 6, we have the old high and the old low. So the old high and the old low is basically this is the old high here, and then this is the old low here, and also this can be the old low here. So price is most likely to come back and take out this old high and came back to take out this old low. So the next step is to come back and take out this old low. So price is going to come back around these areas to take out this old low. So price gonna come back to take out this old low, and then from here price is going to come and take out this old high here, because there are sellers that are sitting around this level. As much as when price came down here, there were buyers sitting here. That's why this week went below from the old low, below, to take out all the buyers. And then the last one, we have the rejection block. So the rejection block is basically, let me take out this, delete. Rejection block is this candlestick here. This is a rejection block. So the rejection block and the old lows and the old highs, they go hand in hand. So this is a rejection block, and also this is a rejection block. So rejection block, basically it is when a price high or a low have formed with the long wicks on the highs of the candlestick, and price reaches up above or down below the body of the candlestick to run a buy side or a sell side liquidity out before price declines. The price comes back to trade above the body of the candle, then it rejects by leaving a wick. So above the body of the candle there is liquidity. So basically around this, in this high above here, we have liquidity sitting. There's liquidity sitting around these levels. So price is gonna come back and take out this liquidity, and then it goes down again. So yeah, like this. So price is gonna come back to this level, and it will stretch to take out liquidity above, and then as soon as when it's done taking out liquidity, and then it goes back down. So guys, this is the ICT institutional reference points. There are only 7, so all you need is these points of interest for you to enter all your trades at and to get profits. So when it comes to GJ, knowing all these things, it helps to bring you closer to making more profit. And also when it comes to synthetic indices, these help a lot, because synthetic indices always react around order block, fair value gap, and mitigation block and breakup block, and there's always a liquidity void no matter what, as much as there's always old highs and a rejection block. So thank you for watching. Please like and subscribe.